rules. Money rules. Money. Welcome to the Money Rules Podcast, where we tackle your personal financial matters with leading financial advisors. Your host, Boitumelo Ntsoko.
Today we're exploring the realm of special trusts and how they can be used effectively in estate planning. These trusts are not one-size-fits-all solutions. They come in different types and each serving a distinct purpose. Today we'll discuss Type A and Type B trusts, their qualifying criteria, benefits and tax implications. Eric Jordaan, a certified financial planner at Crue Invest, joins us on this episode to share insights on these trusts. Welcome, Eric. It's a pleasure to have you with us.
Thanks a lot, Jimmy. Much appreciated as well.
Eric, can you briefly explain what special trusts are and how they differ from other trusts?
Certainly. So special trusts are trusts that set up specifically for individuals who are unable to manage their own affairs due to either age, i.e. them being minors, or having some type of disability, whether it is a physical disability or a mental disability. This is then the main differentiator from other trusts where those specific requirements are not there. So those other trusts can therefore be for any person, and assets can be distributed to any person, irrespective of the ability to manage their own affairs.
Let's explore Type A trusts. Can you explain what they are and who they're intended for?
Yes, so Type A trust is one of those special trusts, and they are specifically there to cater for people with a disability, whether they are either a mental disability or a physical disability. There are very specific requirements, and also that's set out in the Income Tax Act as an example to determine when you qualify under this type of trust.
Can you share with us some of those qualifying criteria for this trust?
Yes. So in order to qualify as a special Type A trust, the trust must be set up specifically for an individual who are then disabled, and that disability must then comply to the requirements set out in Section 6B1 of the Income Tax Act. That's specifies those requirements. In brief, those are that either the individual must be either physically or mentally disabled. There needs to be a certification of that by a medical practitioner, and that disability also needs to be of a permanent nature.
And how does one go about setting up a Type A trust, and what are the tax implications?
Yes, so a Type A trust can either be set up as an inter vivos trust, in other words, a trust that's set up while the donor or founder of the trust is alive, and assets for the specific purpose of that disabled person then are transferred into the trust. So that's an inter vivos trust. Another type of trust that can be used is a testamentary trust, where the assets that is then left to that individual is left through the will, but the will then creates the trust for that individual. So that trust only comes into existence upon the death of the testator. From a tax perspective, a Type A trust does have very specific benefits. So Type A trust firstly is taxed according to the tax tables as applicable to a natural person. So your marginal tax rate will therefore vary from 18% up to a maximum of 45%. But there are also some other benefits from a tax perspective. So as an example, a Type A trust can qualify for the 40,000 Rand annual CGT exemption, as well as where there's a primary residence that's left within the special trust. On sale of that primary residence, you can also qualify for the 2 million capital gains exemption on that property.
Now let's shift gears to Type B trusts. Could you explain what they are and who it's suitable for?
Yes, so Type B trust is then there to cater for a minor, so in other words, someone who's under the age of 18 and who then inherits certain assets. So those assets will then be kept for the minor within this type B trust, and only that minor will then be able to benefit from those assets, and when a trustee can then be appointed to manage those assets for the benefit of a minor. The reason for a type B trust, therefore, is that while a person is still a minor, they do not have the legal capacity to make those decisions on their own, and they would need someone else to assist them in those decision-making processes.
And what are some of the key criteria for establishing a Type B trust, and what is the process as well for setting one up?
Yes, so the key criteria, obviously, for a Type B trust is that the individual who will benefit from the trust must be a minor, so under the age of 18. Further, in terms of the processes, that will obviously be from a inheritance. So it must be someone who's left assets to that minor, and those will then be distributed towards that trust. And then lastly, obviously, that trust also needs to be registered as such with SARS so that they can apply the correct tax rates to the trust.
What are the tax implications for these trusts?
Yeah, so interestingly, a Type B trust also benefits from the fact that it's taxed at the same rate as an individual, so the same marginal tax rates is applied to the income and capital gains that's distributed or vested within the Type B trust, but none of the other specific benefits that's applicable to a Type A trust. Example, the 40,000 Rand annual exemption for capital gains tax and the primary residence exclusion, those types of exclusions is not applicable to a Type B trust. So it's only the marginal tax rates that you benefit from, so either from 18% up to 45% depending on the income of the trust.
Is there any final advice you'd like to share with our listeners regarding these trusts?
Yes, so these trusts are there for very specific purposes, and where those situations arise, I think it's quite important that you get specialist fiduciary practitioners that could help you to set up these trusts and have the right wording within those trust deeds or within your will to make sure that they actually comply and will be able to be registered as such with SARS. To enable them to benefit from the tax rates that's more beneficial with a special trust as opposed to a normal inter vivos or testamentary trust.
Eric, thank you once again for joining us on this episode.
Thank you.
That was Eric Jordaan, who is a certified financial planner at Crue Invest.
Thanks for listening to this episode of the Money Rules Podcast. To listen to more, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. Moneyweb, your trusted source for business and investment insights.